Today we're going to tackle a super powerful trading method, how you can trade the daily range even if you can't be at your charts during the London session.
All right, welcome to AI Explains ICT. In this video, we are breaking down some incredible concepts straight from ICT's core content, specifically Month 8, Episode 8. You're definitely going to want to grab something to take notes with because we're about to cover some really practical step-by-step instructions that you can actually apply.
So let me ask you a question. Do you want to capture those huge daily moves, but your job, your family, or just your time zone makes it pretty much impossible to trade the London Kell zone? If that sounds familiar, you are in exactly the right place.
So here's our game plan. First, we'll talk about the problem itself, the London session dilemma. Then we'll dive into the core concept that makes this all work, the power of 3. That's going to lead us right to the 0 GMT entry point. From there, I'll walk you through the exact steps for both bullish and bearish setups, and we'll finish up with an assignment for you to prove this all to yourself.
Okay, first up, let's talk about the London session dilemma. It's a real challenge, and if you're a trader anywhere outside of Europe, you know what I'm talking about.
And here is the most important thing I want you to take away from this entire video. You absolutely do not need to be awake for the London Kill Zone to be a successful trader. ICT provides a way for you to get into those bigger, higher time frame positions, even if you have to completely skip the London session. It's a game changer.
So, how do we do it? Well, the entire method is built on one foundational concept. So let's get into Section 2 and talk about the power of 3.
The power of 3 is basically the market's daily rhythm. You can think of every daily candle as telling a little story. It starts with the open, then there's a manipulation move, the Judas swing, and finally, the real expansion into the close. Open, manipulate, expand. That's the rhythm. And this image right here shows the two different flavors perfectly. On the left, for a bullish day, price opens, dips down in a fake-out move to a discount array to grab liquidity, and then it explodes upward to the close. On the right, for a bearish day, it's the total opposite. Price opens, rallies up to a premium array, and then sells off into the close. This structure is absolutely key.
Okay, now for the part that really ties this all together. Section 3, the 0 GMT entry point. For this specific model, this is hands down the most important price you need to know all day.
Which, of course, leads to the big question. We know there's a manipulation move during London, but if we're not even there to see it, how can we possibly trade it?
And here is the answer. It's so simple, it's been hiding in plain sight on your charts this whole time. That little tick on the left of your daily candle, the opening price at 0 GMT. According to ICT, that's it. That is the only price point you need to frame your entire trade for the day. Now hold on. That price is completely meaningless without context. Your directional bias is everything. You have to know where price is coming from and where it's likely headed on the higher time frame. Has price just bounced from a daily discount array and is now aiming for a premium array? If so, you're bullish. Or is it the other way around? The previous day's price action is what sets the entire stage.
All right, let's get into the nitty-gritty. Section 4, how to execute the bullish setup step by step.
Here's the playbook. First, your context check. On the previous day, price must have respected a daily discount PD array. If that's a yes, then step 2 is your entry. You simply place a buy order right at the 0 GMT opening price. For your stop loss, you take the 5-day average daily range, or ADR, and you subtract that from your entry. Now, yeah, that could be a 90 or even 100 pip stop loss, but you have to remember, we're gunning for a much bigger higher time frame move. Your target is a premium PD array that could be hundreds of pips away.
Now, let's flip it around. Let's walk through the bearish setup, which has one small but really important difference.
So, for the sell side, your context is that price must have respected a daily premium array on the previous day. Now for the entry, and here's the twist. Instead of selling right at the open, ICT suggests placing a sell limit order 20 pips above the 0 GMT open. This is how you anticipate that Judas swing, that little manipulation rally. Your stop loss is just the 5-day ADR added to your entry price, and your target is a higher timeframe discount PD array.
This visual really makes it clear. You can see the 0 GMT open, you place your sell limit just a little bit above it to catch that protraction, and your stop loss, based on the 5-day ADR, is placed way above that. It gives the trade plenty of room to breathe and protects you from all that London volatility while you're asleep.
Now, you can refine this a bit. For either setup, you could try placing a limit order about 10 to 20 pips away from the open to get a better entry on that Judas swing. If you're nervous about missing the move, you can split your risk. Put half your position on at the open and the other half on a limit order.
The main idea here, the beauty of this method, is that the wide ADR-based stop is designed specifically to keep you in the trade through London's volatility, so you don't get shaken out right before the real move happens.
Okay, we have covered the theory and the mechanics. Now for what is honestly the most important part. Section 6 is your assignment. This is how you turn what you've just learned into real, unshakable conviction.
Here is your homework, and this comes directly from ICT. Go to your charts. I want you to find 3 things from recent price action. 1. A clear-as-day example where the buy setup worked perfectly. 2. A clear example of the sell setup working beautifully. And 3. Find one example where the setup failed. This is so critical, you have to see what failure looks like too. If you don't have the ICT indicator, no big deal. Just use the standard 5-day average true range, or ATR, indicator on your platform. Go and prove this concept to yourself.
And that's a wrap on this model. Hey, if you found this video helpful, please do me a favor and hit that like button and subscribe to the channel for more. If you have any questions at all, drop them in the comments below, and a real human will get back to you. Until next time, safe trading.